How to qualify for and claim higher education tax credits. Paying for college is a major financial hurdle. According to the Education Data Initiative, the average annual cost of attending a four-year U.S. college sits at $38,270. Whether you are a parent footing the bill for your child or a student paying your own way, education tax credits can significantly ease that financial burden. The IRS provides two primary education tax credits: the American Opportunity Tax Credit and the Lifetime Learning Credit. What are education tax credits? Unlike deductions, which merely lower your taxable income, tax credits provide a dollar-for-dollar reduction of your actual tax bill. The general eligibility requirements. You can claim an education credit if you are a self-funding student paying for your own higher education, and no one else claims you as a dependent. Alternatively, you qualify if you are a parent paying qualified higher education expenses for a dependent child. Here are the important restrictions. Both credits have strict income limits based on your modified adjusted gross income and tax filing status. Additionally, neither credit is available if your tax filing status is married filing separately. The American Opportunity Tax Credit features a maximum value of up to $2,500 per eligible student. It is highly valuable because up to $1,000 of the credit is refundable. This means if the credit drops your tax bill down to zero, you can actually receive the remaining balance back as a refund check. The IRS calculates this by giving you 100% back on the first $2,000 of qualified expenses, plus 25% of the next $2,000. To maximize this credit, you must spend at least $4,000 on qualified expenses during the tax year. Who can claim it? To qualify for the American Opportunity Tax Credit, the student must be pursuing an undergraduate degree or another recognized credential. They must be enrolled at least half-time for at least one academic period during the tax year, and they cannot have already completed their first 4 years of higher education at the start of the tax year. Furthermore, the credit cannot have been claimed on their behalf for more than 4 prior tax years, and the student must not have a felony drug conviction on their record. What expenses qualify? Allowed expenses include tuition, mandatory enrollment fees, books, course materials, and equipment. Notably, books and equipment qualify even if you buy them from off-campus vendors. However, you cannot use the American Opportunity Tax Credit to cover room, board, insurance, medical expenses, or transportation. The Lifetime Learning Credit is worth up to $2,000 per tax return, calculated as 20% of up to $10,000 in qualified expenses. Unlike the American Opportunity Tax Credit, this credit is entirely non-refundable. While it can successfully lower your tax bill to zero, you will not receive any leftover amount back as a cash refund. Who can claim it? The rules for the Lifetime Learning Credit are much more flexible than the American Opportunity Tax Credit. To qualify, the student only needs to be enrolled in at least one course at an eligible institution during the tax year. They can be taking classes to earn a degree or professional credential, or simply taking single courses to improve their job skills. Why the Lifetime Learning Credit is more flexible? There is no limit on the number of years you can claim the Lifetime Learning Credit. It applies to undergraduate, graduate, professional degree courses, and solo professional development classes. Additionally, students with felony drug convictions are fully eligible to use this credit. What expenses qualify? The Lifetime Learning Credit strictly covers tuition and required enrollment fees. Unlike the American Opportunity Tax Credit, books, supplies, and equipment only count toward the Lifetime Learning Credit if you pay for them directly to the educational institution as a condition of enrollment. How to claim education credits and avoid double dipping. Before filing your taxes, you must watch out for strict IRS rules against double dipping. You are forbidden from claiming both the American Opportunity Tax Credit and the Lifetime Learning Credit for the exact same student in the same tax year. You also cannot claim a credit for an expense that you already paid for using tax-free funds, such as a 529 plan withdrawal or a tax-free scholarship. However, parents can claim both credits on the same tax return for different students. For example, if you have 2 children in college, you can claim the American Opportunity Tax Credit for one and the Lifetime Learning Credit for the other. When you are ready to file, You will need Form 1098-T from the school showing your total qualified payments, which you will then use alongside IRS Form 8863 to calculate and claim your credit. Other student tax benefits to keep in mind. If you don't qualify for tax credits, or if you simply want to maximize your overall tax strategy, you have two other major options. First option is student loan interest deduction. This benefit allows you to deduct up to $2,500 of interest paid on eligible federal or private student loans. Because this is an above-the-line deduction, you can claim it even if you take the standard deduction and do not itemize. To qualify, you must be legally obligated to pay the loan for yourself, your spouse, or a dependent. Keep in mind that it is subject to annual income phase-outs and cannot be claimed if someone else lists you as a dependent. And second option is 529 investment plans. A 529 plan allows your investments to grow 100% tax-deferred. Your withdrawals and distributions remain completely tax-free at the federal level, as long as you spend the money on qualified higher education expenses. If you happen to have leftover money in a 529 plan after graduation, you can roll over up to $35,000 lifetime into a Roth IRA for the beneficiary, provided the account has been open for at least 15 years and follows annual Roth IRA contribution limits. The final thoughts. Navigating higher education costs is a major financial balancing act, but leaving IRS money on the table only makes it harder. Whenever possible, aim for the American Opportunity Tax Credit first due to its higher payout and refundable nature. If you cross the 4-year undergraduate mark or are taking classes part-time to pivot careers, seamlessly transition your strategy to the lifetime learning credit. Just keep your receipts organized, coordinate your 529 distributions carefully to avoid double dipping, and let these tax breaks do exactly what they were designed to do: lower the price tag on the future. Drop a like, hit subscribe, and let me know what you think in the comments.